Just quick introduction. My name's James Bogart. I'm CEO and president of Bogart Wealth. Part of the presentation today, I do have the question and answer box open as well as the chat box open. We are recording this webinar, so please feel free, ask any questions. If I missed anything, I'm more than happy to follow up on the back end here. So Bogart Wealth's what's called a registered investment advisory firm. We are managing approximately $1.2 billion of client assets. It's roughly 750 households. 90% of those are ExxonMobil households. We are true fiduciaries for our clients. It means that we're legally obligated to put your interest above our own. No hidden agendas, no conflicts of interest, extremely transparent when it comes to how we're being compensated, et cetera. I do believe that any firm or any advisor that someone's considering working with, they need to be true fiduciaries in this environment. We have 19 folks now as part of our team. We also have 4 folks as part of our planning team. We've got 3 different offices, one in McLean, one in Houston, Texas, and one in the Woodlands. And our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. You know, one of the things that I've found is your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. I like to commonly ask the question of what would you do differently now that you know what you know, but back when you were in your 20s or 30s, and we know the impact we can have early on. One of the calls to action for many of our planning events is to actually sit down with us for an absolutely complimentary, no cost, no obligation financial planning session. It's a great way to establish a baseline, see where you're at with things, and really look at ways of enhancing and optimizing your current scenario, as well as modeling out any of the future needs that you may or may not have. And then today's talk is part of our retirement readiness series. We've been doing this now for years. We've been adding topics, et cetera. We do one on the retirement planning timeline. We do one today's on retirement income planning. We do one on Social Security planning strategies, one on tax planning and tax law changes. I'm imagining I'm going to be doing one of those here soon. One on estate planning and estate planning strategies. One on NUA and that's net unrealized appreciation and post-retirement strategies. One on long-term care and long-term care insurance. One on Roth versus traditional 401ks and IRAs. And then one that we've had a lot of popularity on recently has been the mega backdoor Roth strategies. All of our presentations are recorded. They're all on our website. You can see previous versions that we've done. We do update them as we continue to do new versions of them as well. This list came from our audience. So if there's a topic you'd like to hear us talk on, we're more than happy to address it, or at a minimum add it to an existing presentation. Feel free to send me a note or any one of my team members a note, and we're delighted to do that. All right, so as we get into retirement income planning, just a quick agenda. We're going to talk a little bit about why retirement income planning, what's important to you, some of the risks in retirement, and then we're going to be talking about the retirement income planning process, getting into retirement analysis, getting into investment strategies at a high level. We'll talk about withdrawal strategies, and we'll also talk about reviewing and monitoring. I've already had a couple questions come in. I'm going to make sure that I address them throughout the presentation. If I happen to miss them during the presentation, I'll catch them on the back end. All right, so at a high level, why retirement income planning? A retirement income plan will help you plan for and minimize risks that really all retirees must address, and along the way enable us to make informed choices about funding your retirement needs. In order to do so, we need to have a pretty good understanding of what your expenses are going to be, and this really does help us to ensure a more predictable retirement income stream. And then we're going to talk about ways to enhance it, which is understanding, determining a sustainable withdrawal rate, as well as having an appropriate withdrawal strategy that really does help to ensure that your money lasts your lifetime. And then with that, having a plan to be able to monitor and as well as track to stay online with that plan. Now, when we talk about retirement and really understanding what's important to you, this is where there is no normal. Everyone's retirement vision is very different. And some of the key variables would be, for example, family. What impact is your family going to have on your retirement plans? Health. How will you plan to stay both mentally and physically active throughout retirement? How could changes in yours or your spouse's health impact retirement plans? I might even add to that other family members, whether it's your parents or your kids, those can have an impact on retirement plans as well. Your home, where do you plan on living in retirement, or are you going to downsize or potentially even buy a second home? Those are some big variables. Lifestyle choices, what activities give you the most satisfaction in retirement? And then work, will your retirement include some form of working? I don't know a whole lot of folks that retired directly to go back to work, but it's not uncommon to see some consulting work, maybe part-time afterwards. And then legacy. Do you intend on leaving a legacy for loved ones, whether it's your heirs or charitable needs? And then lastly, mind and spirit. What do you want out of retirement? What's fulfilling for you? And again, everyone's going to be different here. And part of the fun of retirement planning is some of the non-financial elements of really how are you going to spend your time. Now, when we look at goals, this is a survey. It's a couple years old now, but it does deliver a pretty powerful message. Of this survey, 79% said they wanted to have a secure, reliable retirement income. 73% said they wanted to have income that keeps up with inflation. 58% said they did not want to have to worry about having enough money. 22% said they wanted to be in a position to help out children or grandchildren financially. 19% said they wanted more time for sports and recreation. 17% for volunteering, 5% to go back to school, and 2% for making philanthropic contributions. What's interesting about this survey is that the top three all have to do with money. And that's a very common theme with regards to setting up goals for retirement. So we then want to talk a little bit about some of the key risk components. And this is one that there are lots of risk components with regards to retirement planning. We talk about some of the bigger ones. And I'd say probably one of the biggest is longevity. People are living longer. For an average couple the age of 65, there's a 49% chance that one of the two of you is going to live to age 90, 20% chance that one will live to 95, and a 4% chance that one of the two of you is going to live to age 100. Inflation also is a very real factor, and I'm going to make an argument it might be a bigger factor recently based on what we've done in response to the pandemic. But just for example, a 3% inflation rate will reduce purchasing power of what's $50,000 in today's dollars down to the equivalent of $23,880 in 25 years. So making sure we have a plan to address increasing costs of goods or the purchasing power of our dollars. I'd also say market performance, whether it's sequence of returns or volatility, those can have a very detrimental impact on a retirement, in someone's retirement plans. So for example, low or negative returns, especially in the early years, those could be extremely detrimental. Same with volatility, and having to sell assets in down markets can also put a significant strain on someone's retirement plans. Healthcare costs, healthcare costs are rising significantly faster than inflation. A recent study said that a couple the age of 65 will spend approximately $230,000 in retirement to cover healthcare. And that's not talking about nursing home or long-term care costs. So healthcare costs are rising dramatically as well. So when we get into what is retirement income planning, this is where we do rely a little bit on historical average to help us forecast particular needs. And I'll reiterate again, there is no such thing as an average retirement. And so what we've done with this process is really get to understand someone's needs initially. Then we talk about strategies associated with how to execute. And then at the same time, to understanding withdrawal strategies and then having a review and monitoring plan. But we want to have flexibility to be able to adapt to the changing environment, whether it's spending changes, life longevity or lifespan changes. We'll look at historical returns to be able to model out various strategies, understanding tax implications. We're going to be real big on talking about tax strategy to ultimately enhance someone's longevity of their portfolio. And then, as I was just talking about, inflation and looking at historical inflation to be able to help us predict some of the upcoming things that we're going to be looking at. So when we talk about analyzing retirement needs, we want to understand what makes your retirement unique to you. Prioritizing lifestyle goals, but also setting realistic expectations of how we're going to achieve them. And one of them is just understanding how much income you're going to need each year. and recognizing that will absolutely change. One of the things I like to talk about a lot is typically when a retiree first enters retirement, they enter into what we call the go-go phase. Then they start to transition to the slow-go phase and eventually a no-go phase. It's not uncommon. You have a very active period of retirement and then it starts to wane. Now, I will admit, a lot of folks retiring right now due to the pandemic haven't been able to do a lot of what they wanted to do, but there's some pent-up demand that we're ultimately, I can anticipate as the economy reopens and people can get back to doing what they were doing, we are going to see a little bit more of kind of that catch up, if you will. But this is where we want to realistically understand and estimate what the expenses are. And we do like to break them down, what we would categorize as essential expenses, which I would call are your needs, versus the discretionary expenses, which is more of the wants, and then have an understanding of potential unexpected expenses or potential wealth transfer goals to kids or charities, et cetera. And when we understand spending, this is where, when we talk about essential expenses, we would define those as food, housing, healthcare, insurance, et cetera, versus discretionary is entertainment, travel, gifting, country club memberships, et cetera. And it's always fascinating to see, especially for husband and wife, who prioritize what is a need versus the other prioritizes as a want. For example, we had a couple where the wife said, I need a new Mercedes every 5 years. Well, that's categorically more of a want than a need, but it's one where everyone is a little different there. We want to have some money set aside for emergencies as well as those unexpected expenses. And then along the way, we need to be adjusting or making an assumption that your cost of living needs are going to adjust with inflation. Another interesting polling that was done, it was actually released in 2019, but again, sends a very common message. But this is breaking down median U.S. household according to the U.S. Department of Labor, Bureau of Labor Statistics. But it segments between ages 55 and 64, then 65 to 74, and then 75 and above. And what you'll notice, a key trend here is that when someone transitions kind of from that first phase to the second phase, most of their expenses are going to go down. Biggest one that goes up is healthcare, and then a little bit going up somewhere around your entertainment costs. No surprise, it's that go to slow go period of time. And then when someone transitions past the age of 75, you'll notice that almost everything goes down with exception of healthcare. So kind of builds on some of the things we've already been talking about, where as you transition in life, there are certain things that are going to go down in cost structure, certain things are going to go significantly higher. Now, obviously, these total numbers might not be reflective of your household. What we found is the typical ExxonMobil household, for example, is 2 times these. Sometimes not quite 2. Everyone's going to be different in terms of how they're spending money or what their income needs are. But in general, what you will notice is there is a little bit of slowing and a decreasing of expenses that go through. And so as you're building out a plan, we might want to have dedicated budgets for certain or particular needs, things that are important to you. Now, inflation assumptions. This is one where we do know, for example, healthcare costs are rising faster than cost of living adjustments. We also want to potentially build in extra costs in later years to consider things like long-term care. In order to do so, we need to understand what the income sources are. So we're going to look at Social Security or employer pensions. We'll look at personal savings and investments. We're going to look at rental income, business or employment earnings. We'll also potentially look at things like inheritance or sale of homes or reverse mortgages. Those are kind of more of the secondary assumptions, but things to all factor in. And then determine what works with your plan. Now, when we talk about income sources, the 3 most critical portions of someone's income sources are cash inflows. One is Social Security. You have to factor Social Security in. Frankly, I do believe it still will be there. I know there's a lot of rumblings around the solvency of the Social Security program. Now, we have a whole presentation dedicated to Social Security, but at the end of the day, Social Security was never designed to replace 100% of anyone's income. On the lower end, 90%, and theoretically less than 1%, depending upon what your expenses are. For the US median, we find that it's somewhere around 40% of income replacement. For the typical energy employee, it's anywhere from 10 to 30%. And here's how we talk about this. So for example, if you're living on $11,952 a year, Social Security will replace 90% of your income. If you're right at the first bend point, which is you're living on about $72,024, it'll replace 42%. If you're right at the maximum wage base, which is the maximum amount that Social Security tax is at, which is 142,800, it's going to replace 27%. And as you continue and you spend more than that, the replacement is less than that. So it's all dependent upon your situation and what you're spending. Now, the next up is looking at the annuity options or any type of pension options you have within your program. Also not designed to replace 100% of anyone's income. The fixed annuity replaces on the low end 12%, on the high end 65% of someone's earning. And the formula is very simple. It's your years of service, 1.6 times years of service times your average pensionable pay. There's a Social Security offset depending upon the age you are when you retire. But what we found is the typical career employee who's retiring at the age of 60, it'll replace approximately 50% of their expenses. So very simplistically, let's just say that the pension's replacing 50% of your expenses and Social Security is replacing 10%. Well, that's 60%. I don't know a whole lot of folks that are retiring and want to live on 60% of what they were making. So ultimately, the delta needs to be made up for savings and investments. Now, real quick, we just show this in here to kind of demonstrate the formulas. This is the very, very old ExxonMobil pension projection tool, but you can see the formula. So the 1.6 times years of service times average pensionable pay. Here's the Social Security offset. That gives the basic single life annuity option. And then we're able to translate that over into what the pension lump sum numbers look like. Now, in terms of accumulation within the pension program, we get asked this question a lot. It is dependent upon someone's age when they commence, but also dependent upon how much of their income they're replacing. So for example, someone who's retiring right at the age of 55 with 15 years of service, well, that, as I mentioned, is going to replace about 12% of what they were making. Now, we do know that, again, if somebody's retiring right at that 15-year mark, between the ages of 55 and 60, you're going to see approximately a 5% per year accumulation. And again, this is assuming your 15th year of service is right on those birthdays. But then it gets essentially flat once you attain the age of 60. Now, for those that are what we call career employees, a little longer in duration, we do see approximately an 8% accumulation from the age of 55 all the way up to the age of 60. And then it drops to about 3% if you continue to work into your 60s. So there still is accumulation there. Now, if you are retiring and no longer continuing to add years of service, we need to have an understanding of what trajectory we're going, whether it's lump sum versus annuity, and what the impact of discount rates are on continuing to leave the program there and not commencing benefits at that point in time. So one thing to just bring in mind. All right, so the other thing we wanted to talk about was some investment strategies, and not necessarily recommending any one particular strategy, but just educating on what the options are. And what we focused on here was the 5 most commonly talked about investment strategies. So the first is annuities, and we'll get into the details of fixed annuities, index annuities, or variable annuities. The second is using bond ladders. The third is more of an income-oriented approach where we're looking at things like big dividend-paying stocks or things that are providing cash flow. The fourth, is more of what we call fixed asset allocation or modern portfolio theory. Some people even call it just indexing. That's another strategy to look at as well. And then the fifth is something that's a little bit more dynamic in nature that does make adjustments based upon what's going on with the underlying economic environment. But at the end of the day, what we're really trying to do here is remove the emotional element as much as possible from investment strategy, because we do know that fear and greed can lead to reversing human psychology, which is buying high and then selling low. We want to have a process in place that's going to help you from preventing making those wrong decisions, which are typically led by emotion. And so it's having a strategy in place that's going to protect for essential expenses with a foundational income stream, and then employing strategies for volatile market environments, whether it's withdrawal strategies or spending and harvesting strategies. Now, within this, let's talk a little bit about each of them. So here's the annuities. Now, with annuities, there's 3 basic types of annuities. And this is specifically talking about if you were to take the lump sum and go invest in annuity, a little different than if you took the annuity from your employer plan. But for example, a fixed annuity is very much like a bank CD. It's a fixed rated return, And all of the funds are held in what we call a general fund, one big common pot, and you have your respective allocation. And I'll flip to the other end and talk about variable annuities. Now, the easiest way of describing variable annuities is a lot like mutual funds. You can set the investment portfolio, typically they're model allocations. There are going to be fluctuations with the markets based on that, and each variable annuity is held in a separate sub account. And then in the middle is what we call indexed annuities. And they're typically kind of described as a hybrid between fixed and variable annuities. A lot of times these are designed where you can get a percentage of participation with the market or whatever respective benchmark you're going to track it against. And they will provide a floor on how much downside risk you're going to have. Now, these also are held within a general fund. Dependent upon someone's comfort level with risk, and an annuity is something we might want to consider. Now, I am a big proponent. If that is the case, we really should consider, for example, the employer pension program or a percentage of it. For example, ExxonMobil's used to be you could only take 100% lump sum or 100% annuity. Now you have the ability to do a combination, 75-25, 50-50, 25-75. That's kind of opened up the door. If we really want to have a guaranteed portion of the income stream, really do like to consider that as part of the options. With annuities, typically the biggest con on these or negative associated with them is the cost. They are relatively high in cost. They also have restrictions in terms of time frame, durations. A lot of them are 7-year redemption penalties if you want to cash out earlier, things like that. Just all something to be aware of as we're looking at this as part of the overall strategy. Now, bond ladders. Again, very simple illustration. So I'm just going to assume a 3-rung, 3-year bond ladder. And to illustrate the point, let's assume that we've got 300,000 that we want to allocate towards bond ladders. So we'll put 100,000 into a 1-year bond, 100,000 into a 2-year bond, and then another 100,000 into a 3-year bond. As the 1-year matures, we reinvest it into a new 3-year. As the 2-year matures, we invest it into a new 3-year. And as the 3-year matures, we invested into new 3-year, and it's like a ladder. The thing is we're living off of the income off of these types of strategies. Now, historically, bond ladders have had some pretty attractive yields. The problem is as interest rates have come down, the yields have become less and less attractive. So for conservative investors who are looking for income, a bond ladder strategy hasn't been as popular in recent years, especially with as low as interest rates are. And just to kind of illustrate this, so for example, we can see bond ladders anywhere from 2.8% out to 4.7%. Now, 4.7% means we've got a lot of long-term bonds in there, 30-year bonds, or we've had to go to lower quality bonds. So for example, corporate bonds right now are paying anywhere from 1% up to 2.5%. Flexible income funds are paying in income somewhere around 5.3%. We got mortgage bonds that are down to about 1% to 2%. International bonds really aren't paying a whole lot. A lot of them are actually negative, but the average is around 0% to 0.1%. Then we see preferred stocks somewhere around 5.35%. Royalty trusts or limited partnership deals anywhere from 7 to 19%. There's a lot of risk associated with those, but they do provide good income streams. And then dividend paying stocks are now paying anywhere from 3 to 7%. And we compare that as a baseline to the 10-year treasury, which is now at 1.043%. So the key point is in order for a very conservative investor to look just at fixed income or just at bonds, it's become a struggle. Money markets, for example, 10 years ago, were paying close to 5%. Now money markets are down to 0.2, maybe 0.5%. You're just not able to get yield on very conservative investment strategies anymore. And so this is where we start to introduce like a dividend stock approach. And so one of the things that we like to talk about is introducing one of the portfolios that we're managing called Prime Income. And a lot of times we compare it to ExxonMobil stock. Now, I'll talk to this. Obviously, the slides don't address 2020's history yet, simply because 2020 is almost anomalistic in how much ExxonMobil dropped and their yield dramatically increased. We are going to update this slide, but this is looking at historical price for the Prime Income portfolio versus ExxonMobil. And so part of what we're looking for is reliability of cash flow, but at the same time too, we want to see performance as well. And so in that same time frame, we can see where ExxonMobil started at roughly a 2% dividend yield, and yes, it has grown but a lot of that has been because the stock price has stayed flat or gone down as they've increased the dividend ever so slightly. Whereas we look at a more diversified approach, and again, I'm just comparing this to prime income. It's one strategy to look at, but a diversified approach of dividend paying stocks where we're getting anywhere from 4 to 4.5% dividend yields. And that has been increasing at the same time too. It's continuing to go up. Now, these approaches, they're not risk-free at all. You're investing in individual stocks, but you're going into that strategy because of the cash flow that it's providing to you. And it needs to integrate with your overall investment strategy. It's only one segment of a stock market or risk-oriented portion of a portfolio. But again, it's designed and it's more conservative in nature simply because it provides a cash flow. One of the things that we want to talk about or we'll want to have addressed as part of someone's overall investment approach. Now we'll compare this to the fourth option, which is really more of what we call modern portfolio theory or asset allocation modeling. And what we're doing here is the concept is if you have a portfolio that's 100% invested in stocks versus a portfolio that's 100% invested in bonds. Now stocks, obviously you should get a higher rate of return, but you're taking more risk. Whereas bonds, you're going to get a lower rate of return with less risk. Now, the concept with setting up an asset allocation model is that if you combined a portfolio of stocks and bonds, you're going to get a more consistent, higher overall return with less overall risk. So for example, a portfolio that's 40% stocks with roughly 60% in bonds, you're going to have less overall risk, less overall returns. Whereas if you go 50-50, you start to get a little bit more overall return, a little bit more risk. And a portfolio that's 60% stocks, 40% bonds, you're going to get comparable to a 100% bond portfolio, but you're going to get higher overall returns. Now, the only challenge I have with an asset allocation model is I believe they're perfectly well suited for the accumulation phase of life, but they don't always integrate or address a retiree's need for cash flow. And this is typically when we talk about market cycles and as they're going up and going down, as you need to generate an income strategy, selling in a down market based upon whatever's going on with the overall economy, that could be very challenging to the longevity of someone's portfolio. And then the last approach we talk about is more of a dynamic asset allocation model here. And what we're doing to set the stage here is recognizing things change as time goes on. Just to use an analogy, at the start of the 20th century, railroad stocks represented 63% of the US equity markets and just 0.2% a century later. By comparison, Russia, India, and Austria-Hungary together represented 25% of the global equity markets in 1899 and less than 1% a century later. And related to that, we are going to have periods of sustained economic downturn. We look at 07 to 09. I'm sure we're going to be adding 2020 into this mix, albeit the market performance has been stimulated by a lot of economic, the market performance this year has been stimulated by a lot of fiscal and monetary policy. So it doesn't necessarily reflect a sustained downturn from a market perspective, but we do need to address or have a plan for the inevitable. You know, we do see economic downturns and recessions, particularly typically every 10 to 15 years. And having to have that addressed in terms of your overall portfolio approach is extremely important to the longevity. And so with dynamic, this really is structuring more of a process, not necessarily trying to time the markets. It's looking at actual trends, not beliefs or predictions. And what we're doing is we're looking at the relative strength of assets as they're performing versus each other compared to even cash. And so we are going to make adjustments in investment approaches along the way, factoring in things like geopolitical concerns, economic upturns, downturns, industry or sector opportunities, or even things like changes in interest rates. And you want to align your approach with the asset classes that are performing the strongest and be able to adjust those dependent upon the environment that you're in. And very simplistically, this is the periodic table for financial assets. But what you'll see here, and it's probably relatively hard to read, but the point is the colors don't stay the same, or the best performing asset class is the best forever. They do cycle through, and having an investment strategy that can be able to adapt or adjust dependent upon what's going on with the underlying economic environment, it's something that we believe is very important. Every strategy has its pros and cons. For example, a big con with dynamic is you could potentially be reducing risk But at the same time, too, we could see quantitative easing or some type of stimulus, and the market does do a true V shape. And so, as you've been hedged or a little bit more conservative, you might not capture all of that rebound. I would make the argument that over a full market cycle, you'll more than make up for it by preventing some of the more sustained economic drawdowns. But again, I think every approach needs to integrate different strategies dependent upon your needs. I do think that any advisor that you're talking to needs to be able to talk about different types of investment strategies, not just the only one that they're familiar with. All right, so I want to transition to talk about withdrawal strategies and talking about how to manage distributions. Now, there are three what we call commonly talked about methods for determining or generating a paycheck from someone's portfolio. The first is income only. Now, this is where you're withdrawing just interest and dividends from your investments. The second is more of a what we describe as a bucket approach, where we've got a dedicated short-term, intermediate, and long-term portion to your investment strategies. And then lastly is more systematic in nature, which is where we take pro rata amounts out of the portfolio, no matter what the markets are doing. I will tell you, I'm a little biased. I'm a big believer in the bucket approach. I love having a short-term, intermediate, and long-term bucket. That's how we would like to set up most of our clients' portfolios. So we have certainty or visibility on where our clients' cash flow needs are coming from, and then have vehicles in place that are helping replenish those buckets and being able to generate additional cash flow along the way. Now, related to this is understanding and managing distributions. Where is the paycheck coming from? And again, everyone's situation is going to be different. So there are three different types of what we would call account types. Non-qualified, which is typically after-tax assets. This would be checking account, brokerage account assets. These are money that as they grow and pay dividends, you're going to pay tax on dividends along the way. And as you sell things there, you're going to pay long-term capital gains rates. And then we have qualified assets. This is pre-tax money. Typically, it's 401ks, it's IRAs. This is money that's continuing to grow tax deferred, but when you take it out, you have to pay ordinary income. And then lastly, there's Roth IRAs, which is after-tax money. It's growing tax-free, and when you take the money out, it's tax-free. Now, each of these have their pros and cons associated with it. I do think it's prudent to have some money allocated in each of them, depending upon how you've had the ability to save. Now, one thing to be talking about, though, is, and this is common for a lot of our ExxonMobil households, is managing future required minimum distributions. So one of our core competencies is tax optimization as well as tax preparation. And what we're trying to do is understand how can we make smart tax decisions today while you're either working or as you're transitioning to retirement that minimize also future tax implications. It's almost a little bit of a chess game. But where we know we can add discernible value is on that tax optimization side. Now, one of the things we have to talk about is required minimum distributions. What required minimum distributions are is when you turn the age of 72, you're forced to start taking a percentage of your retirement accounts out every single year. And that percentage increases every single year with age. Now, you obviously can take more than that, but this is the required minimum amount that you have to take out. If you withdraw less than the RMD amount, then you're subject to a 50% penalty. So very, very steep. Plus, you have to pay ordinary income on it. Now, RMDs apply to 401ks and IRAs. They do not apply to Roth IRAs. Now, inherited is a separate category. But the point is when you reach that magical age of 72, we start to lose some of the flexibility from a tax planning perspective. And that's why prior to that is when we should be doing a lot of that integrated planning. Here's just a quick example of that, the RMD table. Now, there is a proposal that's been in a proposal for over a year now to change the RMD percentage. Right now, it is the old distribution schedule. We are looking for that new distribution schedule to be approved. It's not been a high priority, but the point is that when a retiree retires at the age of 72, they've got to take out 3.9%. And as I mentioned, that percentage increases every single year. That when you hit that magical age of 115, you have to take out 52.6% of your retirement accounts. Pretty steep. But the point is for most retirees, when they're in their 80s, this 5.8, 6.1, 6.5, those are heavy RMDs, required minimum distributions, that ultimately cause you to be forced up into higher tax brackets. That's where ultimately a lot of this tax planning, tax optimization work comes into play. And here's a quick example. So this is a client's scenario where they were retired last year in 2020, and now they've got after-tax assets, non-qualified assets that they can live off of for several years, which really brings their taxable income down. And then ultimately, as they get into their later years, specifically when they hit the age of 72, they start having exposure to the 33% bracket and then transitions to the 35% bracket. And so in the base case, they don't have a whole lot of Roth assets. They've got some non-qualified assets, some pre-tax or qualified assets, but very little in Roth. And what we proposed was a scenario where while we're in those low years, let's go ahead and do some conversions. Let's look at each year what your taxable income's coming in at, and then what we call bracket bumping. Now, some of this planning is going to change. Under the new administration, I think it's a very high probability we're going to see higher tax policy. But in the base case, we know in 2025, we're going to see higher tax rates because the 2018 tax reform sunsets back to what they were. But I do think we're going to see reform prior to that. I don't think it's going to happen in 2021. I think it's going to be in 2022. But the point is we need to be able to adapt the environment that we're in. If 2021 is going to be the last low year under the current tax rates, then maybe we want to look at doing some more Roth conversions this year and wane away in future years. But the point is we're going to build out a pro forma every single year, and we're going to execute based upon what our client's actual taxable situation is. And what's interesting related to this is now all of a sudden this household's taxable assets, they go down a little bit, but their tax deferred assets go down big time. And now they're transitioning wealth over into an environment that's going to be going to the next generation tax free. Now, ultimately, it doesn't necessarily have a linear effect in terms of how much someone's portfolio goes up, because we are going to have to pay tax today in order to save on tax in the future. And so this is kind of what we're illustrating related to this is first, we're going to look at what is the impact on reducing RMDs. And this is an example where just by doing some conversions with this bracket bumping, this particular household was able to significantly reduce their RMDs. But most importantly, why we care for them is looking at the total tax savings. So as I mentioned, we're going to have to pay some tax now, but we really do manifest most of the benefit towards the tail, which is on the back end, reducing overall tax implications. For this household, it's about $518,000. At the end of the day, everyone's asset profile is different. Point is that if RMDs are going to be punitive, it doesn't matter if your portfolio is $1 million and you're spending $30,000 a year, that's going to make them punitive. If you've got a $5 million portfolio and you're spending 200 grand a year, it'll still be punitive. Want to make sure that you're addressing it based upon what your needs are today versus what they're going to be at age 72, and have a plan in place associated with that. And in order to do so, we need to understand the tax implications of the different sources of our income. So for example, Social Security, it's typically taxed, 85% is taxed as ordinary income. Pension income, interest income, as well as IRA and 401k distributions, all taxed as ordinary income. Dividend income, as well as long-term capital gains, they're taxed at capital gains rates. I'll come back to that in a second. Roth IRAs, not subject to taxation, as well as liquidation of any investment principal. If you've got money market funds, for example, not creating tax implications. And this also leads to an additional planning scenario where we want to understand. Related to this is, ordinary income rates as they stand today, they go from 10% to 12 to 22 to 24 to 32 to 35 to 37. Whereas long-term capital gains rates go from 0% to 15% to 18.8% to 23.8%. Now, again, this is a planning scenario. If you have the ability, for example, to live on after-tax assets and bring your capital gain, your ordinary income rates very, very low, so below the 12% threshold, which is approximately $82,000 of taxable income, well, then you can have long-term capital gains rates at 0%. I know lots of households that are living on $150,000 a year, but their taxable income is way below that. Related to that, if you're going to have a high year, for example, anybody who's got a supplemental pension or additional payments plan and is retiring in 2021, well, that's probably going to be a high year for you once you factor in severance pay and vacation pay and all of that. This might not be the year to go realizing big capital gain scenarios. So if you have the ability to go from, for example, where you'd be in the 23.8% to the 15% next year, we might want to factor that in. Now, tax isn't the only deciding factor, right? And it's one that's important to integrate. But when we look at someone's cash flow needs, we also want to understand what are the implications, for example, with Medicare premiums. A lot of people kind of get surprised by this. When they turn 65, they're going to transition over onto Medicare Part A and Part B, and then they're also going to have a supplemental plan to keep their insurance coverage continuous. But your Medicare Part B premiums are based on your tax returns from 2 years prior. So, for example, 2021s were based on your taxable income from 2019, and it continues on after that. And it's not uncommon that people get surprised because we've been looking at all of these other strategies and not factoring in what the Medicare tax is from having a higher level of taxable income. So I do believe that any strategy that we're looking at employing, whether it's the Roth conversions or harvesting capital gains, we need to make sure that we're factoring in variables, for example, such as Medicare, and what the implications of our decisions are going to be associated with them. In terms of general rule of thumb from a spending perspective, I do like to spend non-qualified assets first, then transition over and look at spending down the qualified assets, and then lastly, looking at Ross. But not everyone is going to be the same in terms of what are the overall tax implications. You might, for example, not have a huge level of legacy concern, leaving money to the kids, for example. So we might want to use Roth money, for example, to help with bringing taxable income down so we don't have some of the inadvertent effects associated with Medicare planning, as an example. But I would also argue related to that, as required minimum distributions might have a bigger and bigger implications in later years. We're just making a trade-off of paying tax now again versus paying tax later. So we got to factor all of that in as we're looking at the overall strategies. All right. So a couple things. You got to have a maintenance plan on your portfolio and understanding how to assess how is performance doing. And performance isn't just how are the accounts doing, right? A lot of it is also related to how are you doing from a savings perspective if you're still working and a wealth accumulation. Have you had any surprises on the asset side or the income side? Unfortunately, we've been dealing with some of the households that were impacted by the involuntary program. Well, that's a material change. We need to make sure that we're integrating that from a planning perspective. How's your spending? Are you spending more? Are you spending less? Making sure we're factoring that in. I'd say also portfolio. How's performance relative? Anyone who's got a lot of energy stock right now, they're feeling it coming off of 2021, coming off of 2020, whereas the rest of the market did extremely well, and there were certain sectors that didn't. It's not just energy, it's anything hospitality, anything travel, anything service oriented. All of those guys were impacted last year, whereas you had certain sectors that just shot through the roof. And then understanding withdrawal rates, understanding how withdrawal rates are impacting the longevity and the success of the portfolio. And then do we need to make any adjustments associated with what's actually happening with inflation as well as your spending? And then overall health and wellness of your portfolio related to your goals and expectations. Now, the reason that I bring up the portfolio and how long it will last and what your withdrawal rate is because it is a leading indicator. It's a leading indicator for longevity and success of your portfolio. So for example, and this is just a hypothetical, but let's say your portfolio projection return is at 5%, inflation's at 2%. Now, if you're withdrawing at 3%, that actually, it looks like on the chart that it's going to last forever, but the longevity at a 3% withdrawal rate is about 99 years. If someone's spending at 4%, the longevity is about 43 years, 5% is about 29 years, 6% at 22 years, 7% at 18, 8% at about 15 years. So very telling, right? If you're hovering around this 8% withdrawal rate and you're retiring in your 60s, we need to have a serious conversation on spending or potential changes in lifestyle. But it is a good leading indicator to understand success. So with having a plan in place, we want to understand, again, starting with that reasonable initial withdrawal rate, we want to have a foundation for essential expenses, having a withdrawal strategy in place for any of the discretionary expenses, but then also having a diversified portfolio that's going to be able to help with a lot of the volatility associated with the markets, and then implementing spending and withdrawal strategies that will dramatically increase the probability of success throughout retirement. Now, a couple things with withdrawal strategies. People ask this question a lot. Spending strategies. If the portfolio of if your portfolio return had a positive year more than you expected, I'm very okay with spending more, but we need to have a cap in place because recognizing not every year is going to be a good year. So, for example, you might want to increase your income by inflation with, like, for example, a 6% cap. If your portfolio's had a negative year, maybe we don't increase your spending that next year, as an example. And then related to that, withdrawal strategies, where the money is coming from. We want to look at interest and dividends first. Then we're going to look at assets with positive returns. We're going to start with stocks, and then we're going to transition over to bonds. Next up would be cash. After that would be assets that have negative returns. First would be bonds, and then we'll transition to stocks. So a lot of stuff we covered today. I really do want to emphasize you need to have a plan. If you haven't put yourself in a position to be able to make decisions quickly, we really, really need to get that in place. Bogart Wealth, as well as many other very successful firms out there, they do offer complimentary plans, absolutely no cost, absolutely no obligation. We grow 100% by referral. And part of the reason we're doing the plans is because it gets us a great opportunity to meet each other. I do think that any advisor that you're considering to work with, I always put this in on the slides, but they have to be fiduciaries. In today's age, you need to have transparency with how your advisor is being compensated. I do think that it's important to understand what a true fiduciary is versus more of what a hybrid fiduciary. So, for example, if an advisor is at a broker dealer like one of the big wirehouse firms, they aren't true fiduciaries because they're all licensed. They actually can sell product as well as act in a fiduciary capacity. Whereas any of the RIA firms out there that are true fee only, they are true fiduciaries too. There's absolutely no conflict of interest associated with what they're doing. I also believe that they need to be certified financial planners. They need to understand the employment plans for your company, ExxonMobil, or any company that you're at. They need to understand the IRS rules around your plans. They need to have over 15 years of experience, and they manage their own portfolios. There is a unique difference between a firm that creates its own portfolios versus one that's just picking funds and shopping it out to somewhere else. It allows you to have direct line access to the people that are making the decisions for your investments. Related to that, though, I do believe that they need to be able to discuss various strategies. And then most importantly is tracking performance versus your plan. And we do believe that part of our job is to be good translators and stewards, and that you're able to understand what we're doing and the why behind what we're doing with it. All right. I did have a couple questions I wanted to make sure I addressed. You guys were pretty easy on me here. Yeah, I already talked about Roth money, suggestions to minimize Medicare Part B. Again, Medicare related to timing for how you're generating your paycheck. You need to understand the sourcing of the money. So the qualified versus, after tax versus qualified versus Roth, and integrating that into the overall strategy and looking at it year over year, but recognizing what are the impacts that we're going to have in future years, not just the present. So yes, it might cause us to have to pay a little bit more in Medicare now, but by the time you turn 72, for example, when required minimum distributions kick in, that could be extremely detrimental long term. A lot of times what I like to do is we have our baseline level of income coming in. If we have after-tax assets, we use those initially, use those lower income years to do Roth conversions. And then as we transition away from having a significant portion of assets in after-tax, we'll start using the IRAs or 401ks for cash flows. And then we'll preserve the Roths for all the surprise stuff. Because inevitably we have surprise stuff, roofs, cars, kids, whatever. And that typically is a nice way of segmenting and keeping in line with our long-term strategy as well. Now, if you're in the position where pulling from the IRAs aren't going to bring you up into a higher bracket or impact Medicare, then I would rather use the IRA than the Roth. Roths historically are the last place I want to pull from. But again, if it's part of our overall strategy, I'm okay accepting it. And then what is your suggested strategy for making quarterly preliminary tax payments? So related to how you're pulling your money, if you've got a lot of after-tax money, you absolutely need to get quarterly tax payments done. Now, one thing that's always something that needs to be monitored is related to what year you're retiring. And there's something that's called the safe harbor rule associated with the amount of tax that's owed. So for example, if you're going from when you're working and you're in a relatively high tax bracket to being retired and living on after-tax assets, well, you have to withhold at least 110% of the prior year. If your obligations are significantly lower, we want to make sure that we're religiously withholding enough to avoid interest and penalty. Now, you don't necessarily have to withhold 110% in a year that you're significantly lower, but you want to make sure that you're withholding enough on what you've created taxable events for. And each quarter is going to be different. That's why a pro forma needs to be done related to those, and then have the appropriate payments sent out by the 15th of the month prior to that. I do think that, and by the way, if you're pulling money from IRAs or 401ks, there's automatic withholdings that are going to happen, and just making sure that withholding percentage is in line with what your actual ordinary income event is for that year. All right, let's see. I think I hit all the questions that have come in. Couple things. We do have some upcoming events next week. I'm going to be doing one on how discount rates affect the ExxonMobil lump sum. February 10th, we're going to be doing one on mega backdoor Roth conversions. On the 17th, I'm going to bring back the retirement timeline. And then on the 24th, I'm going to be doing one on the Social Security and Social Security planning strategies. So thank you again. Here's our contact information. If there's anything that we didn't talk about today that you're interested or have a question on, please don't hesitate. Feel free to reach out. We're here to be a resource for you. Most importantly, stay healthy, stay well, and take care. Bye-bye.